So how do you get it right with a whole life insurance policy? Specifically, if your goal is cash value. Meaning, if you're going to pay any amount of money into a whole life insurance policy, and you state, I'm taking this policy out because I'm interested in the cash value. The death benefit is not the primary reason, not right now at least. You're interested in the whole life insurance policy because of the benefits that come with the cash value. That it's a safe, liquid, and tax-free area to position money. Tax-free if we don't trigger a taxable event. But you're interested in the product. However, you want to make sure that you get it right. Because when it comes to whole life insurance, it's very easy to get it wrong. You can take one policy and pay the exact same dollar amount into it. Say it's the exact same policy with the exact same company. You're paying the same dollar amount per year into the policy, same out of pocket to you, but you can see drastically different results. One policy could have as little as 0 of your payment in cash value in the first year, and the other policy could have between 80 to 90% of what you pay into the policy in the first year. Same product, same out of pocket to you, but drastically different results. Why is that? This past weekend, my wife and I were out with some family friends. They're a bit older than us. They are in their early 70s. And the wife asked me, Steve, what exactly does your company do? And we've never talked business before, and we were out. I didn't want to talk about business too much because it wasn't appropriate in the setting that we were in at the time. So I said, our company sells whole life insurance. That is the product we sell. However, just about everyone we work with buys the product not for the life insurance piece. Meaning when we work with them before they start a policy, it is very common for us to hear, I don't care about the death benefit. I'm interested in the cash value piece. Now, that got her interest, and she began to ask a lot more questions. Because what I did not know, she had whole life insurance. Her and her husband had whole life insurance. They had it for a very long time. And they said, when we took that policy out, it was just kind of straightforward. We paid a premium. We had a life insurance policy, and the cash value has built up over time, and it lasts until a certain age, beyond age 100. And we talked a little bit about their policy. They actually had a type of universal life insurance. It wasn't whole life insurance. But what intrigued her was learning that with a whole life insurance policy, it could be set up in a manner where instead of me just selling her a policy and saying, here's a life insurance death benefit, here's how much it costs you in premium. Instead, she could say, here's how much I want to pay in, and I can actually reduce my insurance premium. I can really shrink that as low as I can, and then just add more money into the policy to maximize the cash value. Yes, that's exactly what you can do. That's what our company does. And by the way, where I learned all of this is before I ran my own company and got into the business owner world and learned so much about business, I worked at a company where I learned a lot about how corporations take out whole life insurance policies for the corporation, the company itself. They'll often take out policies on the corporation's executives, in which the company owns the policies, funds the policies. The cash value is an asset on the company's balance sheet, and the life insurance is on the executives' lives. The thing about those policies is that they're often set up for maximum cash value, meaning when the company funds those policies and an individual can do the exact same thing, so say instead of a company, it's you funding these policies or a policy, instead of having 0 or a very small amount of your payment in cash value immediately, you can see the majority of what you paid into the policy in cash value in day 1. And then you have a positive cash value, meaning more money in cash value than what you paid into the policy somewhere between 3 to 5 or 3 to 6 years, depends on your age, if you have any health issues, and how much you're funding the policy with on a yearly basis. But my point was that it's a huge, huge difference depending on how that policy is set up. And really what we're showing individuals and companies, small and large businesses we work with, is how to minimize the insurance expenses and maximize the cash value benefit. That's what our company does. We set up policies for maximum cash value because people we work with are interested in the cash value piece of a whole life insurance policy. So how do you get it right? Well, here's the key on this, and this is what we had discussed. I mentioned it a little bit when the wife had asked the question. When you pay money into a life insurance policy, in green here, this is your money going in. Instead of just purchasing a life insurance policy, you can choose where that money goes. It can go toward the base premium. This will give you less in cash value, particularly upfront, or you can pay money toward this PUA rider. PUA stands for Paid Up Additions Rider. This is the terminology that most insurance companies will use. So this PUA rider will give you more cash value, especially right out of the gates, and especially when you look at the guaranteed values on a whole life insurance policy. So the name of the game is this, and again, this is if you're trying to get it right and maximize the cash value benefit of a policy. We want to reduce the premium piece, this base premium, to the minimum. The follow-up question I would have if I'm a customer would be this: what's the minimum? Well, the minimums are determined by the insurance company. The insurance company has limits. Sometimes they're different depending on the product I'm considering. And then also the IRS. IRS limit has to do with this term, MEC, which represents Modified Endowment Contract, or MEC. So a side note here, because she did ask during that conversation, she said, you know, I was surprised that our agent never told us about this because he was a sharp guy. He seemed like the type that would know a lot about whole life insurance and how to really maximize the cash value. And my response was, you know, he might and he might not. When you look at the training in the life insurance industry, there is very little training around how to set up these policies for high cash value. So one, an agent has to know how to set up a policy for maximum cash value. But then number two, they have to be willing to do so. Because if I'm going to set up a policy that reduces the insurance premium and maximizes that PUA rider in order to maximize cash value, what that is going to do for me as the agent is reduce my commission to the minimum. So if the limit is 10% of my total payment can be directed toward the premium, and then 90% toward PUAs or paid up additions, how much am I reducing my commission to? Assuming that I just start out with a basic whole life insurance policy where all of my payment goes toward premium, now I'm going to only put 10% to the premium. I'm going to cut it down to about 10% of what it could be. Now there are some commissions on PUAs, so maybe it's 15%. But my point is, if I'm in the industry and I look at you taking out a policy and I show you option A where I can make $10,000, then option B where I only make $1,000, that goes back to my response to her. The agent needs to be willing to show you these types of policies, because that's how it works. When you look at the life insurance industry with cash value life insurance products, we as agents are incentivized to write policies with more money going toward the premium and less money toward PUAs. When you look at just how it works, that's the truth. I make more money if more money is going toward the insurance premium. So we're going to talk about the policyholder and then also the agent. So we looked at this chart here already. We've got the policyholder, base premium equals less in cash value. PUA rider equals more in cash value. Then we've got commissions. Base premium equals more in commission, whereas the PUA rider equates to less in commission. And a quick side note I'll mention is this. Watch out for this. In the years in being in this business, what we often hear and see sometimes from those in the industry is that if you go with a higher premium, you should have more money, meaning more cash value long term. So if you go with a high premium, that means the agent will make more money. But when you look at the cash value of a life insurance policy, there is a chance that you could have more money long term by going with a higher base premium, but we've never seen that actually happen. And if you're very conservative and want to look at the guaranteed values of a life insurance policy, what you'll find is based on the guaranteed values, that a minimum base premium, not a higher base premium, will give you more money long term. So in summary, or to simplify, if we reduce the premium and reduce the commission, as low as we possibly can based on the limits that are available from the life insurance company. That will maximize cash value. Reducing the premium and maximizing that PUA rider results in more cash value for the consumer and less commission for the agent. Again, that's just how it works. I'm not saying that agents are bad for getting paid or earning commissions. That's how we operate our business. But when you look at the model and how the business works, that's it. So let's look at a quick example here. Let's assume you're paying in $10,000 per year. So we've got a policy, $10K per year is what you're paying in. You put 100% of that $10,000 toward the base premium. So we've got $10,000 here. Okay. As the agent, let's just assume a 100% commission rate, which is not always going to be the case. It depends on the company and product. The major mutual companies all pay less than 100% commission. Our rates are not that high. Some smaller companies will pay much higher rates than 100%. We've got other videos that go through commissions. But let's just assume we've got a 100% commission rate. What that means is the agent will make $10,000. Whereas the policyholder, specifically in the first year, will have zero in cash value. Now, as you continue to make premium payments, you will see those premium dollars build cash value. But right out of the gates, we've got nothing. Now, let's say you pay in $10,000, but you do it a bit differently. Instead of putting it all toward the insurance premium, you elect to do this. You put $1,000 toward the insurance premium, which generates $1,000 for the agent. Of that $1,000, nothing shows up in cash value. But then you pay the other $9,000 toward PUAs, which will give the agent, first and foremost, the commission rates range between 2 and 3%. So it's a small amount there when we look at it. Let's say it's just for simplicity. I go in the middle, $250. So that's what the agent earns in commission there. But then the policyholder of a $9,000 PUA payment might see somewhere in the neighborhood of $8,500 in cash value. Could be a bit higher than that, actually. You will see PUA fees associated with this rider. Fees are different depending on the company, which is why we don't see 100% show up in cash value right away. But remember, when money's in cash value, it does begin to compound for us via dividends and interest. So we'll quickly make up for whatever that fee was that was assessed to the PUA payment. So the name of the game here is, how do I reduce this and maximize this? Let's wrap up with an example of an illustration with one policy with two different setups. So what we've got is the first policy. We're going to multiply the funding by 10. So we've got $100,000 per year going in just for 10 years. Why pick 10 years is because it gets a total of $1 million into the policy. 100K per year for 10 years, total of $1 million. There's your cash value. There's your death benefit. This illustration has a 100% premium. And we can see it right here. Okay, let's look at the same policy. So look at this, whole life 95. You've got it on a 40-year-old individual, but set up differently. This is how you get it right, going back to the theme of this video. Here's your premium. Now we've got other riders and such associated with this. I would check out this video about how to design a policy for maximum cash value if you'd like details behind this. But now we've got a premium just about at 10%. We're maximizing it based on the limits that are available. Same whole life 95 product, same 100K per year for 10 years, same million over 10 years, cash value and death benefit. Different figures. If you had a chance to look at the first year cash value in the last illustration, it was much, much less than that, wasn't it? Yeah, it was $3,000 and change. So let's do this. We're going to look at a comparison. This will be interesting. of the two illustrations we just saw side by side. Number one, we've got the traditional policy. 100% of the payment is allocated toward the base premium. The PUA rider in purple is 0. Your annual outlay is $100,000 per year for 10 years. When we look at this, what do you notice? Total funding, this tallies up your total payments. Let's not zip down. Year one, what's your cash value? $3,500. Meaning you paid in $100,000. Your cash value is $3,500 right out of the gates. Now with this particular company and product, the commission rate on premium dollars is 85%. That's if you've worked your way up to that level, meaning you've brought the company a lot of production. With many companies, it'll be higher than that. Some will top out at 95%, and again, smaller companies can be 130% plus. But this one's at 85 on the premium. So that means you make $85,000 on one sale. Now let's look at the same product, but designed differently. Going back to that point, the agent is incentivized to sell that policy. Here's why. Because now we've got the same product with the same out-of-pocket for you, but what's the difference? Well, of that $100,000, you've got $10,000 toward the premium, which was actually $9,000 and change if we go back to the illustration, but we rounded up here and we added that term insurance rider as well. I didn't go through the illustration of that piece, but I did include that in the premium piece here. But you've got $10,000 toward the premium and then $90,000 toward the PUA rider. Okay, same out of pocket, but what's the difference in value? The first year, you've got about 88% of what you paid in, $88,000 in cash value compared to $3,500, where you made a payment of how much? $100,000. Let's highlight in yellow our break-even point. Break-even means when you have more in cash value than what you paid into the policy. So what do you notice here? World of difference, isn't it? The difference is to who? You or the agent? Both. So 85%, again, of the premium piece is the commission. So here, it's $8,500, which is still a very healthy commission in my opinion. But if you've already had a taste of this, that's where it can be hard for an agent to say, wait a minute, I'm going to sell the same product for 10% of what I would otherwise make. There's a commission on this, and with this product, it's actually 3.25%. Well, my point is, you can see a drastic difference in compensation to the agent depending on how the policy is set up. But then also what you have is a drastic difference when we look at the cash value. It's fascinating to me. No matter how long I do this, look at this. Same company, same product, same out of pocket to the consumer, but by year 10, you've got $200,000 more in value. And this is based on the non-guarantees. Imagine if you saw the guarantees, it would be amplified. But as time passes here, we stopped funding in this example, the gap continues to widen. Last thing, and I'll close with this, where I like these maximum cash value designs, one of my favorite pieces about it, has to do with this term right here. Flexibility. With a traditional whole life insurance policy where you are only paying a premium, if life happens, does the premium have to be paid? Yes. If you have cash value built up, that cash value can support some or all of that premium. Sometimes through the dividends and interest that are being produced, and then sometimes through a policy loan. But that's a large bill every year. Compared to an example where we have a minimum premium, what are we committed to? Yeah, this guy. I'm billed for the premium, and then we can set up a policy where this PUA rider is very flexible, so I can add additional funds to PUAs at my discretion. And I don't have to either. Now that will impact the cash value that I see on an illustration. If I'm paying in less, I'll have less in cash value. But now I've got a lot of flexibility, which for many people, loosens the vice grips. So now the policy doesn't feel like a burden where I've got to pay this huge bill every year. I can commit to a small amount, dump more money in at discretion. I've got a healthy death benefit, and then I've got this cash value that continues to appreciate, that is safe, liquid, and tax-free. Again, I can access it tax-free if I don't trigger a taxable event, such as a MEC or other taxable events. I would check out our video above. But that is, or the example on the right, is how you can get it right with a whole life insurance policy. The number one form of buyer's remorse that pops up when it comes to whole life insurance is someone finding out after the fact that the policy they started could have been set up for more cash value, specifically that the premium could have been lower. So how do I make sure that I get it right? Know the rules of the game, as I like to call it. What are the limits that the insurance company offers for the product I'm looking at? What are the IRS limits, specifically the MEC limit? Ask questions. How low can I go on the premium? What is the MEC limit? Can I add term insurance, a rider, to raise that MEC limit without raising my premium? I've got to know a lot of times to ask the right questions to make sure it is set up properly for cash value. And again, that's if cash value is my goal. So I hope you enjoyed this video. If you did, please let us know. Please hit the like button, subscribe for more. If you have any questions or comments, please leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.